Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending February 23rd, 2024. So looking at the markets this week, lots of black on the screen. Lower inflation in Canada helped bond returns. Nvidia earnings, of course, fueled the stock market on the week. Canadian dollar, euro, and gold higher versus the USD. So looking at inflation first and what it means for the Bank of Canada and interest rates. So we fell below 3% in January, which is good news. That was fueled by still food and shelter. So this is what's still behind the inflationary pressures that we see here. Inflation is volatile, and we're expecting it to be volatile for at least the first half of this year, volatile around the 3% level. So we don't think that necessarily we're on a highway towards 2%. Case in point, last week we were discussing how in the US inflation just rebounded, so we should have some volatility. We do see that what's driving inflation in the chart here, there's a lot of colors, but if you look at the rightmost point, you see that it's mostly shelter that is behind inflation, and then you have, so that's the gray part, the dark blue part on the bottom is food inflation. If you take those two components out, there's not much left, and if you just remove the shelter components from inflation, you're back at something that is more in line with 1.5% right now. So this begs a lot of questions about what the Bank of Canada should do. So next chart here, the question that we're asking, and we feel that the Bank of Canada is asking itself that question also right now, it's should we remove the shelter components from the rates equation, and meaning that even if inflation stays sticky, because wages are still sticky, shelter components will remain sticky for a while. Should the Bank of Canada start cutting anyway to just give a breath of fresh air on the Canadian economy, because we are seeing what we've described a few times as a recession per capita in the country. So on the left, you have the mortgage cost inflation, which this is not an error, 28%, 27.3, I think, percent inflation here year over year. So this is households renewing their mortgage, refinancing their house, and at a higher cost, so you pay more interest on a weekly, bi-weekly, or monthly basis. So of course this is money that goes out of pocket to pay for the same service as before. You were already servicing your mortgage, so this is inflation. So there is no problem with the methodology here, but it's there. It's not because the economy is too hot, it's because interest rates went up pretty quickly. So you need to take that into consideration. And on the right, the inflation for rents, well, it's not because of underlying economic pressure. The Bank of Canada does not have any direct impact on that with their very blunt tool, which is monetary policy and an interest rate. It is about demography. Demography is strong, and also we are seeing that housing starts, building permits are down because of the high cost of capital, so the cost of borrowing, thus high interest rates. So is it time to separate the two and say, well, the job seems done on the factors where monetary policy does have an influence, and also maybe cool down inflation by lowering rates, favoring more projects to come online for supply on housing, and also push back the mortgage cost inflation component. So this is a tricky plane to land. I would say the Bank of Canada is talking about these things, started talking about these more seriously somewhere in December, but recently the bank is talking about housing. In the latest monetary policy report, there was a chart showing that, well, if you exclude the shelter components, inflation is on target. So you're seeing them just sowing the seeds of that. So we are thinking that rate cuts will come starting this summer. We are still expecting 4 rate cuts. The date that we have penciled in is January 24th, where there's a meeting by the Bank of Canada decision, which comes with a new set of forecasts and monetary policy report, a press conference. So this is what we think is the most likely date to see the start of rate cuts. And after that, 1 cut per meeting until the end of the year. So that would bring the leading rate to 4% at the end of the year. But I would say that the consensus is this wide now. So if you listen to other economists, if you look at what what the economic teams at Canada's banks are thinking. Some are thinking it's going to be much earlier than what we think. Some think it's going to be later. So, it's a very uncertain environment, but our pick right now would be that we get started in July, and until then the Bank of Canada is making the message clearer and clearer that we can look through the housing components and start cutting interest rates now to help to support the Canadian economy. So this is what we're thinking, but a very interesting number on inflation here. So moving to Wall Street, of course, this week the Nvidia earnings were the topic in the market. So the rocket continues to soar. On the left, you have some of the details here. I should say that this is from the Globe and Mail. Nvidia adds a record $277 billion in stock market value in one day. That was a jump of 16.4% for a stock that is already that has a market capitalization that was already close to $2 trillion. So that's a heavy weight here. This is the equivalent of adding more than the market cap of Netflix in one single day. So this is huge. In fact, that's the Wall Street largest one-day gain in history. So there's a parallel here to be made with what we saw in the 1990s. And I'm not saying that there's a bubble or anything. This is a revolution. The AI revolution is happening. How to invest in that team? Well, in the 1990s, it used to, what happened there, it was the hardware providers that led the gains at first. So then it was Cisco, now it's Nvidia. And then after that, when things became clearer about the direction of what the internet was becoming then, now what AI is becoming now, then after that, it was, a second order. So the software providers, the servers providers. So, this theme will likely have some legs. The AI team, of course, it will stay important in 2024, but for now it's all about the chip makers. So looking at the Magnificent Seven now, so on the next chart here, Magnificent Seven was an important theme in 2023. Now maybe starting to see like a divergence appear within those seven. So starting on the chart on the left, you see that since early 2023, the Magnificent Seven, the total return is about 100%. So about a doubling in market capitalization for these names. So that's the line on the top, on the left chart, the line on top. The dark blue line is the performance of the S&P 500 over that period, so about 30-35%. And if you exclude the Magnificent Seven, you're left with the gray line, which is more in line with 15 to 20% the return since early 2023. When you look on the right, you see that within the Magnificent Seven, there's some divergence here that are starting to become important. Especially look at Nvidia on the right. Earnings growth has been astronomical. Even if the multiples have contracted over that period, the gains were exceptional. And look at Tesla, which is sitting next to Nvidia here. It's being punished. Earnings growth is not as good. So you're starting to see some divergence here. So maybe we'll retire the Magnificent Seven call somewhere in 2024, maybe focus more like on the chip makers, but we are seeing some divergences appear here. So this is a blend of software and hardware. Maybe hardware will be leading the way and software will come after. But very interesting to see the developments here and to see how Nvidia is just beating expectations that were already very elevated. So fueling the optimism on Wall Street here. So what to watch next week? GDP growth in Canada should reaccelerate on a yearly basis to 1.6% in December. For the US, we'll have the Conference Board Consumer Confidence Survey, which should be going sideways in February. PCE core inflation, which should reaccelerate on a monthly basis. And the ISM Manufacturing Index, which should go sideways, a bit below 50, so still in contraction zone, but pretty neutral overall. So that wraps it up for the week. ia.ca/economy for the review for the podcast. iagam.ca/insights for the monthly, for weekly publications, and also insights from my colleagues at IA Global Asset Management. So that wraps it up for the week. Always a pleasure to serve you. I'll be back again next week.